Number 1. Apple. Apple is the world's most valuable company, and for good reason. Its ability to innovate with products like the iPhone, Mac, and Apple Watch keeps its revenue streams diverse and growing. Beyond hardware, Apple's services segment, including the App Store and iCloud, generates high-margin recurring income. Its brand loyalty is unparalleled, with customers returning year after year to upgrade. Financially, it boasts a massive cash reserve and minimal debt, making it one of the safest blue-chip investments. Apple, S tier. Number 2, IBM. IBM was a titan in the early tech industry, but has struggled to remain relevant. Its mainframe and enterprise solutions business is shrinking, and despite acquiring Red Hat, it has failed to compete effectively in the cloud computing market. Recent moves to focus on AI and hybrid cloud services are promising, but still haven't delivered significant growth. Investors appreciate its steady dividend yield, but declining revenues and heavy competition hold it back. IBM, C tier. Number 3, Coca-Cola. Coca-Cola has one of the widest moats in the stock market, with a global footprint and an iconic brand recognized in every corner of the world. Its strong pricing power and distribution network make it a reliable income stock, and its dividend is among the most dependable on the market. However, as consumers shift to healthier alternatives, Coca-Cola's core soda products face declining demand in key markets. While still dominant, the company has to innovate further to maintain growth. Coca-Cola, A tier. Number 4, General Electric. General Electric, once a symbol of American industrial strength, has seen its legacy tarnished by poor management and excessive diversification. Its businesses in aviation, healthcare, and energy are now being broken up in a bid to restore value, but the road to recovery is steep. High debt levels and years of underperformance have made it a cautionary tale for investors. While there is potential for a turnaround, it's far from a top-tier blue chip. General Electric, F tier. Number 5, Microsoft. Microsoft has transformed itself from a legacy software provider into one of the world's leading innovators in cloud computing, AI, and productivity tools. Its Azure cloud platform is second only to Amazon's AWS, and its subscription-based Office 365 ensures consistent recurring revenue. Unlike many other tech giants, Microsoft balances growth with strong dividends, making it a favorite among both growth and income investors. Its dominance across multiple sectors, from gaming to enterprise software, cements its status. Microsoft, S tier. Number 6, Walmart. Walmart is a retail giant with unparalleled scale and a robust logistics network. Its ability to offer low prices gives it a competitive edge, even against online competitors like Amazon. Walmart has also expanded into e-commerce and grocery delivery, showing adaptability in a changing retail landscape. However, its low margins and heavy reliance on volume-based sales mean that its growth potential is limited compared to more tech-focused companies. Walmart, B tier. Number 7, Johnson & Johnson. Johnson & Johnson is the cornerstone of many defensive portfolios, known for its healthcare products, pharmaceuticals, and medical devices. Its diverse business segments insulate it from market volatility, and its long history of dividend growth makes it a reliable income stock. While it has faced legal challenges, including lawsuits over talcum powder, its strong financial position and market-leading products ensure long-term stability. Johnson & Johnson, A tier. Number 8, AT&T. AT&T has struggled in recent years, with costly acquisitions like Time Warner and high debt levels weighing heavily on its performance. Its dividend yield is among the highest in the market, but that has come at the expense of growth. While its telecommunications business remains strong, the company's poor execution in media and streaming services has been a major setback, forcing a spin-off of Warner Media. The uncertainty surrounding its future keeps it well below the top tiers, a T&T C tier. Number 9. Procter & Gamble. Procter & Gamble dominates the consumer goods industry with household name brands like Tide, Gillette, and Pampers. Its consistent cash flow and ability to pass on costs to consumers during inflationary periods make it a defensive favorite. However, growth is slow due to its reliance on mature markets, and competition from private labels in emerging markets challenges its pricing power. Despite these hurdles, P&G remains a reliable pick for income-focused investors. Procter & Gamble, B tier. Hey there, I'm Henry Huang, and I will help you simplify your investing journey with simple, easy-to-follow videos. If you're an investor looking to diversify with alternative investments, or just a beginner curious about cryptocurrency, but you don't know where to start or feel overwhelmed by the amount of information out there, then you're in the right place. I've put together a free training that will walk you step by step through the world of crypto, from understanding the basics to making your first smart investment, perfect for complete beginners. Just click the link in the description to grab your free training and get started on your own journey today. Number 10. ExxonMobil. ExxonMobil is a titan in the energy sector, benefiting from its integrated operations in exploration, refining, and petrochemicals. Its ability to generate massive cash flows during periods of high oil prices makes it attractive, especially as the demand for fossil fuels persists globally. However, its exposure to oil price volatility and the growing shift toward renewable energy pose long-term challenges. While Exxon is adapting with investments in carbon capture and hydrogen, its future remains uncertain. ExxonMobil, B tier. Number 11. Berkshire Hathaway. Berkshire Hathaway, led by Warren Buffett, is a conglomerate like no other. It holds a diverse portfolio of companies and investments, including Apple, Coca-Cola, and its own wholly owned subsidiaries in industries like insurance, railroads, and utilities. Its financial strength and lack of dividends reflect its reinvestment strategy, making it a growth-focused blue chip. The company's size and diversification protect it from market downturns, but its returns can be slower compared to tech-heavy competitors. Berkshire Hathaway, a tier. Number 12. Tesla. Tesla, the pioneer in electric vehicles, is one of the most polarizing blue-chip stocks. Its rapid revenue growth and industry leadership in EV technology have made it a favorite for growth investors. However, its valuation remains extremely high relative to earnings, and it faces increasing competition from both legacy automakers and new entrants in the EV market. While it's innovative, Tesla's volatility and dependence on future breakthroughs keep it from the top tier. Tesla, B tier. Number 13. Visa. Visa is the backbone of the global payments industry, facilitating trillions of dollars in transactions annually. Its high-margin business model, minimal debt, and growing presence in digital payment technologies make it a blue-chip standout. The company benefits from macroeconomic trends like increased cashless transactions and e-commerce growth. While it's not a high-dividend stock, its consistent revenue growth and profitability secure its position as one of the safest long-term investments. Visa, S tier. Number 14. Intel. Intel was once the undisputed leader in the semiconductor industry, but has fallen behind rivals like AMD and NVIDIA in innovation. Production delays and missteps in transitioning to advanced chips have hurt its market share and reputation. While it still dominates the PC and server processor markets, its inability to keep up in GPUs and AI-driven technologies limits its growth prospects. Despite a strong dividend, Intel is far from reclaiming its past glory. Intel, C tier. Number 15. Meta. Meta, formerly Facebook, is a leader in social media and digital advertising, with platforms like Facebook, Instagram, and WhatsApp driving its revenue. Its recent focus on the metaverse has been divisive, with heavy investment dragging down profitability. While its core ad business remains highly lucrative, regulatory scrutiny and competition from platforms like TikTok create significant risks. Meta's potential for long-term growth is undeniable, but its volatility keeps it from the top. Meta, B tier. Conclusion. Blue chip stocks might seem like the safest bets, but as we've seen today, even the biggest names have their highs and lows. The stock market is full of opportunities and risks. It's all about understanding the bigger picture. Speaking of the bigger picture, if you're curious about how the entire stock market works and want to grasp it all in just a few minutes, I've got the perfect next step for you. Check out my video, Stock Market in a Nutshell, where I break down the fundamentals in the simplest way possible. Trust me, it's a must-watch if you want to truly connect the dots. Click the video on the screen or find the link in the description. You don't want to miss it. See you there.